You can go ahead.
All right. My presentation is called Selling Option Premium, Creating the Next Day's Trade Plan and Loading Conditional Orders to Fill Automatically. I'm going to take you through my process, but I just wanted to also start off with just a couple of words of wisdom. Well, first, I always like to put up my disclaimer. Anything I talk about with charts or examples, these are just for illustration and educational purposes today. Don't consider any of this advice or endorsement to purchase or sell anything. I do not and cannot give financial advice over this particular call, and nobody associated with me here at my trading trainer company are registered to give us financial advice. We don't trade on people's behalf. We don't recommend or receive any payments from any broker. We're just here for educational purposes. But I want to give each one of you, before I start showing you exactly what I'm doing in the evenings here, how to crack the code. So these are just words of wisdom. First of all, I want to make sure people stop chasing shiny objects, right? Everybody is going to try to wow you with their materials, right? What I recommend is turn off the wow-o-meter and settle on one type of investing, and then just sit down and learn it well. You know, people are always going to flash shiny objects in front of you, but all you have to do is pick one. I'll tell you that, especially the folks that were on the call all day today, because I've been tuning in and out throughout the day, they're all super duper valuable. So just pick what really resonates with you. And when you pick what really resonates with you, make sure you take it into consideration what your personal life can do. Like, for instance, if you're busy during the days, then don't get involved trying to master something where you have to be in front of the computer during the day. Take that into consideration, as well as what really appeals to you, and then just dig in deep and figure it out, learn it, use the tools, all that good stuff. Number one. Number two, make sure you hire somebody, you know, all of us are mentors, who's currently doing what you want to be doing, and especially knows how to teach, because there's a lot of investors, a lot of traders out there that know how to trade, but they're not very good at conveying what they do to other people. So make sure you've got somebody who's a good mentor. And again, I think everybody who was on the call today is, you know, matches number two. But make sure, if you're out there and you're receiving all the buttloads of emails and marketing and all that good stuff, that you take a second and evaluate who you're asking to teach you how to do this stuff. Learn from guided discovery. It's so much easier to learn and follow in somebody's footsteps than it is to do trial and error, because trial and error can be very expensive. Also, I recommend you get involved in some sort of investment group with other people that are doing the same thing you're doing, right? Because if you can look over their shoulder and they can look over your shoulder, you can totally leverage with pride, as well as they'll hold you accountable to make sure you keep going so that you don't lose momentum. And in addition, when you do something well or you do something poor, they'll be able to celebrate with you or keep you going when you want to stop, or when you want to like have a moment that other people just won't value, like these people who are doing what you're doing. So an investment group is key. And my last one is surround yourself with like-minded investors. There's so many folks out there who are part of just, you know, watching life go by, and they'll be the first one to tell you that, oh my God, you're getting involved in futures or options or commodities or whatever you want to get involved with, and they'll try to convince you that you're wrong. And so that can actually, because the minute you have, for instance, a trade that goes sideways on you or doesn't do well, you know, you'll hear those voices in the back of your head. But if you surround yourself with people who know that there are those days when some trades will go against you, and they're just like, yeah, that's part of every day, you won't have that nagging belief in you, right? And I've been doing this since 2003, right? Trading Trainer's been around since I started teaching in 2003. So I've seen people who have tried to get by without following these 4 little rules, and it's way harder. So if you can take a moment and jot those down, that would be fantastic. This is exactly what I do, and I did back in the late 90s when I first started investing. I didn't start teaching till 2003, but I started investing specifically in equities and options, and that's really all I do is equity and options, back in 1997. So this is exactly what I did, and I still do, and this recipe is totally the recipe to crack the code. There's no special sauce, no matter how much somebody's, pays a fortune to have copywriters write all sorts of marketing material that'll make you like persuade you to buy their stuff. There's nothing more secret than these 4 little keys right here. So I want you to make sure you've jot those down. I believe I've given you enough time to do that. Now, I told you that I'm going to talk about selling premium. I focus now. One thing that I want to also emphasize, I didn't get the short end of the stick by getting the last slot of the day after the market has closed. I actually asked David if I could do this slot. And the reason is because with my sort of way of selling premium, and specifically for you kind of nerds like me out there, if you're a nerd like I am, it's called theta decay optimized option premium, right? I'm doing the type of investing where I buy and sell or write against these option strategies, and I make money on time passing by, right? And it's a way more, what would you call it? Less emotional, right? I don't have to be there watching trends go up, trends go down, all that good stuff. I'm just simply making money on time passing by, and I have a lot softer, I don't miss opportunities if I'm not there at the split second. Because I have to tell you, my life goes on during the days, right? I don't spend the day staring at the markets. And what I do is I come in the evening, and I usually spend somewhere between 15 and 30 minutes every evening looking over my process, and I'll show you my flow chart I follow, and then setting things up for the next day. And then I don't see the markets again until the next evening, where I catch up where I left off before, see what's happened, make adjustments, set up conditional orders for the next day, and let it go, right? And I focus on these 4 simple transactions. One of them is called covered calls. Another one is called covered puts. That's flipping the covered call upside down. It's really undervalued. A lot of people are very familiar with covered calls, but then when you talk to them about covered puts, they start to shake in their, shaking their shoes. But covered puts are something you need to know, because they allow you to increase the number of investments you can get into by 2, right? Because now you can get into investments at the top of the channel, not just at the bottom of the channel. I also like to write covered calls against leaps, right? Supercharged covered call writing is what I call it. Bull call diagonal debit spreads for you academics out there. That's what it is. It's a variation. I like to make sure that my back month options are trading at parity, and I'll show you how I do that. And I like to write covered puts against leaps. Now, one thing you should know is writing covered calls, the bull call diagonal debit spreads, and the bear put diagonal debit spreads are all things that you can do in a cash account. So if you guys have Roth IRAs, or you have SEP plans that you've set up in your S Corps, or whatever sort of tax deferred or tax free accounts you've set up, or if you're in Canada, your RRSPs, this type of trades works really well for those type of accounts. This other one, the covered puts, it does require a margin account. So you're going to need to have a retail account that has the ability to sell on margin. So just wanted to make sure you have those disclaimers. But those are really the 4 transactions I focus on. And you might be saying, now, some of you, like, what is this option premium? If you ever look up an option price on the big board, either Chicago Board of Options Exchange, or now a whole bunch of other exchanges are carrying options. Options have 2 components. So if you see a price of like $5, right? Part of that $5 is an in-the-money value, also called intrinsic value for, again, you academic folks out there like me, big nerds. And the other half is called the premium value, or the extrinsic value. So what we're focusing on really is selling that premium value component. So with that said, let me take you on a little ride. Now, while Sam was talking over there, did part of my process. So let me bring over this browser window, and I'm simply going to go into the web portal that I have for all the users or participants of my program. And the reason why I'm going into this web portal now is not because I'm trying to pitch my program to you, but it's because all the tools that I developed for my own trading, my own investing, my own selling of premium are the same tools that my folks use. So I don't do anything special or different from what I teach my program participants to use. So this is my portal here. And one of the first things that I do, you know, we've released these cool little flowcharts in our learning center. And I'm going to go here to one of our previous learning replays. We have these once a month learning webinars where we kind of do a deep dive on the end-to-end process. So if you take a look at this particular replay from September's monthly webinar, and I scroll down here, you can see I made for everybody this really cool flowchart that we can follow. I could probably, as soon as it loads, I can put it into full screen. And this is basically what I do every evening. It takes about 15 to 30 minutes maybe on a busy night. So I'm going to make this full screen here. And I'll zoom in a little bit so you can really see what's going on. So begin here, broad market analysis. So broad market analysis is just a few minutes where you kind of take inventory of what happened today. Did the market go up? Did the market go down? Did particular sectors go up? Did particular sectors go down? Was there any sort of news that could have created some correlation where all the sectors went up, all the individual equities went up? Things like that. Then I go ahead and I evaluate any open positions I have, and then I look at how I might evaluate new positions, and if so, craft conditional orders. So that's where I am right now. I didn't want to take you through the broad market because that's just as easy as looking at the big three indexes, seeing how things played out. So I kind of did that in the last 5 minutes of the last person's presentation. So where are we now? I had created or have created these cool screeners. And what these screeners do is they run every evening. They're actually running right now. They usually finish around 6:30 Eastern time. But it doesn't matter because, again, I'm selling option premium. I'm selling the fact that options decay with time as they pass by. So, again, I'm not really focused on looking for directional signals where I need to get in right at the right moment or anything like that. If my screeners find a candidate, that candidate's good for as long as the symbol is sideways channeling. So I don't necessarily have to get in today. I can get in 3 months from now, 4 months from now. So I'm going to look at the screener the last time it ran. I've got actually 3 variations of my screeners. What these things do is they go through every equity ETF and index out there and all of the associated options, and they're looking for premium type trade. So they kind of narrow it down. So for instance, this premium selling screener, this was my original screener that I created almost a decade ago. You can see this is for December 7th, expiration on December 18th. It tells me exactly which tickers and calls and puts to investigate. It's got one this most recent time. You know, you can go back and it's got a history. I also have some new screeners that I've put together over the last couple of years, Beta 1 and Beta 2. So we've got all sorts of different screeners, and it's just the different ways they look at the market. And I'm really a fan of my most recent one, Beta Pix 2. So let's take a look at what we've got there. We've got these high probability symbols to check out. And really what I'm going to check out, and I already looked through this list, they're organized by what price they closed at. I want to take you on a ride with DR Horton because this is one that really appealed to me. So I'm just going to pull over a charting software. I'm going to use Thinkorswim this evening. Here's DR Horton. And the reason why I like DR Horton is it's a boring stock, right? It's not one of these high flyers. It's not a Tesla. It's not a Zoom. Instead, it's one of these companies that's been around since hammer was a hatchet. It's moving in a nice sideways channel. It's established a level of support, tested it almost 3 times here, tested a level of resistance 3 times here. It's just going sideways, boring, Nobody's really focused on it. It's not big in the news. It's had ups and downs because of the COVID crisis, but now it's been going sideways. And this is one I'd want to sell premium on. I don't want to sell premium on the ones that are going to be changing positions. Here's something you need to know. Please write this down if you're taking notes, and I hope you are taking a couple notes. Selling option premium falls into category of option trading strategies called range-bound option trading strategies. That means you want boring stocks. You want stocks that are sideways channeling. You find a stock that's sideways channeling, it's going to keep putting money in your pocket every time an option expires. If you're doing monthlies, that's every month. If it's doing weeklies, that's every week. So with that said, I really like this DR Horton. In fact, I'm going to zoom in a little bit. Here's the last 3 months. Maybe that's too far. Let's go to the last 6 months. And can we all see that there's a little channel forming here? In fact, I'm going to just use my little drawing tools here built into this free software, Thinkorswim. All you have to do is open up an account. You don't even have to fund it in order to get access to this type of software. I always like free stuff. Maybe I'm going to start here at about $67.50 and identify kind of a channel here, $79.50, something like that. I like that little channel, the way that it's going. You'll notice I'm using my Fibonacci price retracement lines. That's a built-in tool here. I've identified the 2 center retracements. That's what I call my center zone. I've got a couple of retracements going outside the support and resistance I identified, but this is just a common off-the-shelf tool here. In fact, one of the things I like to do is I believe that a lot of people invest on round numbers, so I'm going to go in here to the actual tool itself and make it round numbers, $67.50 to $79.50. Slight change, but that's what I like. So that's a nice sideways channeling stock. Again, boring. I'm going to come back to my web portal. The other thing that I do, again, I'm trying to make this as easy as possible. And if I wasn't actually talking to you, telling you what I'd be doing, I'd be going very quickly on this. And most of our program participants are doing the same thing. But you'll notice over here, I've got these downloads. So we made a little spreadsheet tool that we give everybody called the Premium Selling Worksheet. And so we ask people to download it and use it. Then what this thing is going to do is it's going to do kind of the whole trade planning for us. So I want to take you through that process. So I actually already have it downloaded. I'm going to pull it up right here on my computer for you so you can see what that spreadsheet looks like. Give me a second while I pull over. I got a couple of screens here. And so my little file manager just showed up on a different screen. Let me bring it over here. I'm going to go to my Premium Selling Worksheet. And you can see here's the tool we gave people. So I'm pulling it open right now. I'll get this out of the way. All right, so we got the same little disclaimer I give everybody. So let's go to this configuration wizard and let's go ahead and fill it out. Now, it's got a couple of questions. Are you interested in exploring option substitutes for the underlying symbol? That means instead of using the underlying symbol, do you want to explore using back month options? Absolutely. Do you want to make sure that we use married protective options? Absolutely, right? Because, let me pull one thing up for you. These are the 3 steps of selling that premium. We're either going to buy or short an underlying security. We buy it if it's going to be a covered call. We short it if it's going to be a covered put. Or we buy a substitute option trading at parity. That works, again, whether it's the call or put for the diagonal debit spreads. Then the next step is we're going to sell near-term at-the-money options for the premium value, create an instant dividend to profit buffer, and we're going to marry a protective option that's about 3 to 6 months out in expiration to protect the whole investment. If you look at it on a chart, this is just an example. If we're doing a covered call, we would buy our underlying symbol, or if we're doing the diagonal bull call debit spread, we would buy a call option trading at parity. We'd put basically a bailout order in place. And then a couple of weeks later, we could sell that near-term call option and buy that protective put option. That near-term call option expires when your option expires, and we sell back that put option, basically roll it out, and then we repeat, create this ongoing income. Or if you're doing a covered put, that's where you know, if the underlying symbol is at the top of a sideways moving channel, we either short an underlying symbol or buy a put option trading at parity. And then we put a bailout order in place to the top side. When we get to the bottom of that channel, we sell the near-term put option, buy a 3 to 6 month out call option. That near-term put option expires worthless, allowing us to keep that premium, and we basically roll out the call option. So what's nice about doing it this way, legging into it, is we collect two sources of income every time we sell premium. We create a source of income or to the economics of the position when we sell the premium, but we also create a source of income when we roll out the option. So those are really the positions that we're trying to create here. So let's continue here. Now, we also built into our little spreadsheet have different risk models. This is the most conservative. This is before. They want to know what the current cash value of our portfolio is. Now, this is where I would put in my current cash value, but I want to make it a little bit more realistic. So I'm not going to put in my big number. I'm just going to put in a $50,000 portfolio. That's more doable. Now, you'll notice the tool, based on what we teach here at Trading Trainer, recommends how much risk should a position, what's the max allowable risk to the portfolio any position should take. This is one of the biggest mistakes that folks make, is they'll invest way too much of their portfolio into a position and really risk a whole bunch. I've had people, if I had a nickel for every time somebody's cornered me and said, hey, AJ, you know, I was selling premium, and you know, every month I was making, you know, 5%, 10%. I was doing really well, 12% on my money. And I was going great for the first 9 months. And then on the 10th month, I got really excited because I was doing so well. So I put quite a big portion into the trade. Not only did I lose the first 9 months of premium, I also lost half my portfolio. So, you know, position sizing is critical. So in this case, we recommend using a max allowable risk to your portfolio of no more than 2%. That means you'd have to have literally 50 of these trades go horribly wrong in a row to wipe yourself out. You know, you can do more. You don't have to take our recommendations. You could do 3%. You could do 4%. If you start to go above 4%, my tool stops you, because I've always taught for the last almost 20 years that you don't go over 4%, and no one trade should be able to knock your portfolio down by 4% or more. So hard coded into this spreadsheet is a stop there. I'm going to just take the recommendations and go with 2% here. Then it asks me to tell me about the underlying symbol. What is the underlying symbol? So we're using D.H. Horton, the home builder, right? And it wants to know, what did I put down for support and resistance? So we'll go ahead and bring over our little tool here. And we said support was at 67.50 and resistance was at 79.50. Now you'll notice over to the side here, it's telling me, hey, I've measured the width of your channel, it's $12. And I've measured the average channel price of your channel, it's 73.50, and it's done this ratio. I use this ratio all the time. You might want to write this down. If you take the width over the average channel price, you'll get a percentage. You kind of want that percentage to be between 10 and 25%. If it's greater than 25%, your channel is a little wide. It's not going to be consistent. If it's less than 10, then the probability of getting a channel breakout is very high. So you'll notice right here, it's given us a green. If I had a smaller channel, I'm just going to fudge these numbers a little bit to show what happens. You can see here we've got a channel that's somewhere between 10 and 5, and so it's giving you a yellow, and it's saying, hey, this is questionable. And this is all just built in so that we don't my participants don't mess up the math, right? Because messing up the math is the #1 way that people mess up their trade plans. So this is kind of just a way to make sure people don't make mistakes. We give these spreadsheets out. The other thing that's also useful is, again, clerical errors are everything. You'll notice my 50% retracement line in my charting software says 73.50. 50% retracement is the same thing as saying average channel price is 73.50. So you'll notice that these two things align. It's a good way to make sure, again, whatever you've drawn on your chart is matching whatever calculations you're doing. Then it's asking me right here, it says, hey, tell me about your price thresholds. Where would you bail out of this trade? So again, this is a range-bound option trading strategy. We have to say, hey, my risk is going to stop. And you can do all sorts of tricks. You can say, hey, the low of this channel was $64.82. So maybe I'll go 25 cents or 30 cents below that, because if I go below that, where the bottom of these channels have ever gone, I should probably kick myself out or to the top. But one of the tricks I found is using these Fibonacci price retracement lines, right? You'll notice that I've gone 2 Fibonacci price retracement lines outside of my support and resistance. Usually when I have something that's channeling sideways, a lot of times it'll loiter or test itself once or even to 2. But if it goes past 2 Fibonacci price retracement lines, a lot of times it's changed its personality from a sideways channeler. It's changed it all the way over to what we call a trend follower. So I don't want to be in it anymore anyway. So to kind of shortcut things, I'll just pick these two numbers here, 62.92 and 84.08. Those would be great numbers to say, hey, this thing's no longer range bound. I need to liquidate my position, 84.08. Now it also says, hey, you're using married protective options. What would you do for the strike prices? Well, ideally, they would be the same as my bailout prices. However, we know that strike prices don't fall to the same place as they do on the, you can't get down to the penny. So we have to look at our strike prices. So I'm going to come over here to the option chain, and I'm interested in perhaps either the December or the January. For my protective options, like I mentioned, I like to go about 3 to 6 months out, because I don't want those protective options to really decay away with time too frequently. So I'm going to actually look out at these May options. I'm going to take a look at open interest and the bid-ask spread. I'm kind of thankful that there is some open interest on DH Horton. That's another thing I look for on my underlying symbols. Not only do I want them to be boring, but I want them there to be some liquidity. So I like what I've got here. So let's see. My bailout is at 62.92. My strike prices go every 50 cents. So I could use 62.50 or 65. I'll probably use 62.50. It's close enough, right? And over here, $84. I could use the 85 or the 82.50. I think in this case, I'll use 82.50. I can always come back and tweak these, but I'll error to the inside of the channel. All right. So now it's telling me, hey, tell me about the date you're going to pull data from. Your center zone should be between 72.8 and 74.92. So I'll just verify that. Again, I want to make sure I'm not making any clerical errors as I fill in these blanks as I go along. So if I look over here, 72.08, 74.92, so my drawing still matches my spreadsheet. And when I'm feeding this spreadsheet the information to come up with my trade plan, I want to go back to the last time I had a close inside the center of the channel. So I'm going to, again, zoom in on 3 months, and it looks like just yesterday. Yesterday I was in, today I closed a little bit out of the center of the channel, right? The center of the channel is this 72.08 to 74.92. So it'll be a day ago. I'm going to use prices from a day ago to create my plan. So this little tool is going to create a simulation. What is the date you're pulling data from? So let's go to yesterday. Put my cursor over here. It says December 7th. So I'm going to fill in December 7th. Tell me about the underlying symbol on December 7th. What was the underlying symbol price? So most softwares, whether you're using OptionView or Thinkorswim or TradeStation or some web apps like the Charles Schwab or Fidelity, you can look up historical data. In Thinkorswim, we just use ThinkBack. I'm going to put in my ticker symbol here, and my ticker symbol is DHI. And sure enough, it's bringing up December 7th. I could change this date if I had to go to a different day, but this is the one I'm looking for. So $73.80. I'm just going to fill in the blanks. Right now, I'm just copying and pasting data into this little software tool. Tell me about the options for our model. Select near-term at-the-money options from December 7th. Error to the side of out of the money. Okay. If I follow the instructions, near-term at-the-money options are going to be these December 18th options. So let me write that down for our strike price. Expiration date is 12/18. 12/18. Strike price, it says go for at-the-money options. Error to the side of out of the money. So for my call, it looks like I'm going to go with the 74. For my put, I'm going to go with the 73.50. So 74 for the call, 73.50 for the put, and it's asking for the bid and the ask. So for the call, $1.95, $2.10. For the put, $1.85. I'm using my spreadsheet as a straight edge here so I can keep my eyes pinned on it. All right. And then it says, last but not least, let's find some option substitutes. Select options from December 7th that are at least 8 months out and trading at parity. So we got to go at least 8 months out. That would bring me to this leap from 2022. So let's use the leap from 2022. So expiration date, it looks like it's January 21st, 22. January 21st, 22. We'll fill in a strike price. Now we got to find one trading at parity. So we're going to put a stake in the ground, maybe use this one. Again, I'm happy to see open interest. I'm going to use this one that's the $45 strike price. I simply fill in the bid and the ask. Again, all I'm doing is copying in data, 31 and 31.85. And you'll notice a message comes up over here, and it doesn't look too good because it's red. Let's see what it says. It says our in the money value is 91.6 and our premium extrinsic value is 8.4. We're not trading at parity. Try again. It wants me to go deeper in the money, right? To get something trading at parity, you got to go deeper in the money. So if 45 is not deep enough, we can come over here to 43. So for 43, our price is 32.45 and 33.30. Still no good, not deep enough in the money. So I'm going to keep going deeper. The next one is 40. Bid is 34.60. So all I'm doing is letting the tool evaluate. Now I could do this by hand, but letting the tool do it, number one, removes the chance of me making any errors of calculating this by hand. And number two, it's just faster. So here you can see that now that the premium is less than 5%, it's giving me the green light saying, hey, you found an option trading at parity. We'll use that as our back month option. I'm going to do the same thing for the put options. So to go deep in the money with puts, you go higher in strike price. So I'm going to start here with a 90 and see if I get it. 22.50, 24.25. No bueno. So I'm going to go deeper, and it looks like I can go deeper by a bigger chunk. So I'm going to go to 100 strike price. This is $30 and $32.50. Still not there. Let's go to $110. In this case, I'm a little worried about liquidity, but that's a whole nother discussion when you're talking about back month options, because really, you know, if you're getting exercised versus trading them, liquidity doesn't really matter. Well, the last notch on my one here is 115. Let's see if we can find one at 115. Otherwise, we may not be able to use this, or if we do use it, we have to understand that it's not going to be trading at parity. It's close, right? It's got 6.2% premium. We like it to be less than 5%. That's what we're going to have to go with because there's no higher strike price. So we filled in all the blanks, and if I switch over to this tab that says trade plans, you'll notice it's showing me blackness, and the reason is it looks like you need a larger portfolio to trade this plan given the calculated risk. Now, if we decide to use a different risk model, say after maybe, we'll see what we've got. Aha. We've got a couple of different trade plans that appeared, one for the call, one for the put. The bull call diagonal debit spread still won't show, but we do have a plan for buying a bear put diagonal debit spread. So we could actually pull that off any of these 3 of the 4 trading plans. So remember, this one requires a margin account. It tells you right there. This one tells us that we can set up this trade with a cash account. This one says you need a larger portfolio to trade this plan. And this one says you're good to go with 1 contract. So with a $50,000 portfolio, you can do 100 shares in 1 contract. Notice how our plan works. It tells you exactly how to get in. So it says after a bottom is found, you're going to buy 100 shares of some D.H. Horton stock. Make sure you pay lower than $73.80. Make sure you put a conditional bailout to trigger when the underlying crosses below 62.92. Then after a top is found, you're going to sell your 1 contract of the near term at the money calls. At the same time, you're going to buy 1 contract of the protective put, and then you're just going to follow along. So if I take a look at my chart, it almost looks like with D.H. Horton, D.R. Horton, we've got a bottom forming here. So we might have an opportunity to either write a covered call or do a bull call diagonal debit spread. Now, again, with a $50,000 portfolio, the bull call diagonal debit spread says, you know, you're going to take on too much risk. And so it's already blocking me. So we could do a covered call. One thing that's fun to do if you want to make sure you understand how this is going to work is we can actually do some back testing. And I have a few minutes, so maybe I'll do some back testing. So if I was to have identified this bottom, one of the ways I like to do that is by pulling in just a simple moving average crossing, like a 3 and a 5 day EMA. So according to this, my crossing, I probably would have gotten in on a day like this, November 3rd. So right here, we have a testing wizard. Now we can do a testing wizard, and you can use either back testing, or you could actually, if you're paper trading, fill the numbers in as you get them on your paper trading account, and you can test it in the forward direction. Let's do a little back testing for the last few minutes of my hour with you. And then if we like it, we could definitely set up some conditional order entry rules for tomorrow. And then that's it. We'll let it run. If the order fills, great. If it doesn't fill, that's all right. So let's do covered call writing. The first thing it's asking me is commission. So when you're selling premium, of course, commissions make a big difference. So we need to put those in so that it'll factor them in. For me, I don't pay anything per trade, per share of underlying symbol. I pay a penny. For trading an option, I don't pay anything per trade, but per contract, I pay $1. If I'm exercised, my broker charges me a flat fee of $4.95. And last but not least, if I'm bailed out, I don't pay anything per trade, but I do pay a penny per share. Oops, not 10 cents, a penny. Tell me about the underlying symbol. How many DHI shares are we going long? My trade plan told me to go long 100 shares, so I'm just going to stick with that. 100 shares. At what price are we going long? So let's back test it. So if we talked about getting in here, we'll just use end of day prices. This was from November 3rd. It looks like the closing price was $69.46. Now you'll notice it says $69.47 is lower than $73.80. Now why is it saying that? If you look at the trade plan, part of the trade plan was beating your price targets, right? And so if you are testing forward, meaning you're paper trading, and you throw in your numbers right before you paper trade or even real money trade, it'll tell you if you're not meeting the rules of your trade plan. Like for instance, if I put in $75 instead of, if I say, hey, I'm about to open this order for $75, it'll say, hey, dude, your price goal is not met. Don't do this, right? So I'm going to back it up a little bit. I'm using 69.46 from my back testing. Also notice it's saying 69.47. Do you guys know where that's coming from? It's coming from the commission, because even though I negotiated and said, hey, I'm transacting this at 69.46, my tool is smart enough to know that actually the amount I'm paying, I have to pay my commission. So it's factoring that into the economics of the trade. So that's why, if my commission was actually 5 pennies per share, you can see it's calculating that. So it's factoring in my commissions, which is important, like I mentioned. Commissions can make or break a premium trade. Then it says, tell me about the premium we're selling. What is the call option and the price? So if we're talking about getting in at the top, let's go with around here, the crossing. Let's go with this bar on November 30th. So I'm going to, again, use their tool of historical data, and I'm going to go to November 30th. Boom. All right, and so I'm going to look at the December 18th option. So I'll put that down. December 18. On November 30th, it looks like the price was $74.50. And so if I'm going to go at the money and error to the side of out of the money, I mean, that's highly unusual that you would be closing on a day and have it actually be at the strike price. That's kind of neat. So let's use it, $74.50. $74.50. And the price that I paid, somewhere between $230 and $262. So maybe halfway, that would be, what, 16 cents? So $2.46, roughly. All right, and it's doing that same sort of calculation. It's saying, hey, $2.95 is higher than the $2.03. And again, you might be asking, hey, how did you get $2.95 out of my transacted price of $2.46? One thing that's interesting when you sell premium is if you sell a better strike price, right? Because we did our strike price in our initial plan based on a $74 strike price. When it came down to it, it looks like my at the money option when I was at the top of the channel turned out to be $74.50, By selling a better strike price, I've actually locked in, if I get exercised, an additional 50 cents of profit. So to have a apples to apples comparison, the tool is doing the math for you. You'll notice in the trade plan it says compare to $2.03 for the DHI December 74 call. Well, we're selling the December 74.50 call. So it's doing the math, and if it's doing apples to apples comparison, it's adding in that additional 50 cents of locked in profit. It's also taking a penny away because of the commission, right? Even though you transacted at $2.46, you're only going to get to take home $2.45 based on what your commissions cost. And so it's coming up with a $2.95, and that's higher than the $2.03. And so it's giving me a green light there. It also wants to know about the protective option we're using. So if we're using a protective option today, that would be using my May option, and the strike price that my plan told me to use was the 62.50 put. So let's put in the 62.50 put, trading somewhere between 340 and 360. So let's say we get it for 350. Now, do I have the ability to also look up selling it back, rolling it out? Not really, because we may not have found our bottom yet, but why not let's just use this data from December 3rd, this green bar right here, and just say, well, what if we sold it even before the bottom was found? So let's go to December 3rd and kind of simulate. That's November, December, boom, there we go. And again, the 62.50 trading somewhere between 370 and 395. That's about 25 cents. So how about we use 382, $3.82. So a little bit of profit there too. And now that we've filled in the blanks of our simulation, our back test, we can look at the results. It tells me the channel zone, that's between 67.50 and 79.50. Our trade zone, 62.50, that's where the protective put kicks in, up to 74.50. That's where we had our expiration, our exercise price, our strike price. The profit zone, and so it tells us exactly, here's the reward if it gets exercised, here's if the insured protective option kicks in, here's the risk. And so our portfolio, even though we put it in for 2%, says the actual portfolio risk after the first month is only 0.8%. Now let's also say, well, a lot of times, in fact, most of the time, most of our program participants see trades that last about 5 months, 6 months. Let's say we have another premium collection, so another $2.46. So the second month, I'm basically simulating the second month. So $2.46. So that's $4.92. So on the second month, I'm just assuming that I collect close to the same amount of premium. And over here, we were able to make about 32 cents on rolling out the option. So if I wanted to make 64 cents after 2 months of rolling out the option, maybe $4.14. Now let's look at what happens. So this is 2 months. This includes commissions. Now we're talking about after 2 months, if we get exercise, you're talking about gaining 16.3% and only risking 2.2%. Our max portfolio risk went down to 0.3. And then somewhere between the second and the third month, again, if we collect an additional $2.46 of premium, somewhere around $7.38, and we collect another from rolling out the option, 64 cents plus 32 cents, 96 cents. We'll put in this. Then you look over here and you're like, oh, wow. Now all of a sudden, somewhere between the second and the third month of being in this transaction, if I get exercised, I'm going to walk away with a 21% gain. If I get bailed out, I still have a gain of 2.2%. And this trade, because we've set it up in a way that it's just as long as it's sideways channeling, we're just going to keep accruing the profits. What's beautiful about this, and I can't help but keep ringing the bell, is I'm doing like what, 2 transactions a month, maybe 3 transactions a month to manage this position. It's very low maintenance. And at the same time, I'm earning these type of returns, right? And I'm just letting time passing by work on my behalf. 2 transactions a month. I'm not sitting there looking at the computer trying to day trade this thing. I just basically invest my whole portfolio. If these things last 5 months, you know, you'll see these rewards be up here from 50 to 100%, doubling your money. I mean, who wouldn't like to double their money every couple of, you know, every 5 months? I know people are always talking about, you know, especially the people who are trying to get you interested in shiny. They're like, oh, I double my money every day. But on how much of their portfolio and how often does that happen every year? Whereas if you just keep your money invested in these, it's kind of like putting your money into a mutual fund. This is a mutual fund of option premium. But instead of earning 9% per year or 11% on a really good mutual fund, you're doubling your money every 5 or 6 months. It's kind of neat. And with this spreadsheet and with our little tools that help us find candidates, I mean, it's a no-brainer. So what would I do if I wanted to trade this? Well, I would go into my software, and it looks like we'd want to do step 1 because we're finding a bottom. So if I think that we found a bottom, what I do with my trading software, no matter which broker I use, is I put some conditional orders in. I would basically want to make sure that tomorrow D.H. Horton is moving the way I want it to. So I would just say, hey, first thing I like to do is make sure that I put a time limit. I say, wait till the afternoon session. So I don't let any of my automatic trading happen until afternoon Eastern time. Then I'm like, make sure DHI is higher than open, just to make sure it's going in the right direction because I want it to be going up. Also, if there's any gapping, make sure DHI is higher than yesterday's close. So I'll put that rule in there. The other thing I like to do is there's definitely a range I call the open range. It's the high and the low of the first 30-minute bar. So make sure DHI is higher than the high of the first 30 minutes. That's a day trader's trick, 30-minute bar. So if those rules are met, I allow my conditional orders to go through. I'll just buy at the market price. I'll come back at the end of the day and I'll see how many of these have actually filled. If they don't fill, I go through my little flow chart and I decide whether I want to try to get them filled the next day and the next day. And basically, I try to keep my whole portfolio. Now, my portfolio, we talked about a $50,000 portfolio. My portfolio right now is up in the 8-figure range. I've been doing this since 2007 with a portfolio. I just come back at the end of the day and see which orders have filled and which haven't. But this is as simple as it gets, right? And so let me just I have about 3 minutes left according to my clock. I want to let sure I don't see any questions in the Q&A area. So if you guys are interested, you know, I put together a couple of these slides here. let me just blow this up here from the current slide. Boom. One thing I would say to you is that we've had people who want to sell premium start with as low as $800 in their account, but there really is a sweet spot for getting some of these symbols, and that's having a portfolio of $4,000 or more. So if you don't have a portfolio of $4,000 or more, first of all, I probably wouldn't be trying to buy products to learn how to invest. I'd be looking at how to build my initial starting seed account higher. But second of all, you know, selling premium might not be the best for you. But if you do have 4,000 or more, then that might be really smart. I'm going to bypass a lot of just what it gets because you kind of saw the inside of my web portal here. Again, like I said, all these tools that we have are the same tools I use every evening. Every Thursday, we take a symbol and basically do it online with everybody. We usually have somewhere between 100 and 200 people. We call it the symbol of the week, and we actually do these weekly workshops and then hand everybody the trade plan so that they can go ahead and do it themselves. So a lot of folks liked those webinars, and you can watch them on their replays too, as you can see here. They like those because they like to follow along with us and not just try to do it themselves. So yeah, let's see. Here's the scoop. I'm just going to forward right into this, and then I'll be done. I'm going to give you, because it is the holiday, and I'm like, usually we sell this in 6 months of access, because we want you to be able to use it. We want you to be able to ask questions. We want you to be able to attend at least 26, right? 6 months is half of 52. 26 of those weekly webinars and get 26 positions up and running if you wanted to. There's no other charges. You have 6 months of access to all the tools and everything. And so we're going to take $100 off, just like everybody else has been doing if you're interested. And if you are, I'm going to put this into the little message area. It's called http://for.me/promo. There you go. And what you're going to have to do is when you get to that web page, oh, and if you've got a mobile phone, you can just open up the camera and point it at the screen right now. It'll bring you where it says promo code. Please type in 100 DISC and make sure that DISC is all in capital letters, because that'll get you the $100 off. Otherwise, you'll wind up paying the $597 price. There, I put it into the chat again, 100 DISC. If you're having, oh yeah, there's also lifetime access. Why would you want to do lifetime access over the 6-month program? That's because people like to come to those Thursday webinars. I've interviewed people. I'm like, why do you sign up for lifetime? You should be able to do this on your own. You know, we give you the tools to go home with. You don't have to, you know, after 6 months. And they're like, because we like to come to the Thursday webinars. Why would we want to, you know, set up positions when you do it for us every Thursday? So they sign up for lifetime. So we have a very special, let me just fast forward past that, because I don't care if you sign up for lifetime. You could if you want. Blah, blah. Here it is. If you are having problems placing any orders, you could definitely give us a phone call. We'll take your order over the phone. The area code, I'm based out of Colorado, is 970-266-8146. Yeah. And that's all I've got. I hope you enjoyed it. And again, I thank David and Anka and all those folks who have put this on, because just going through and letting, you know, seeing what people actually do, whether it's during the day or after the day, in my case, is really, really valuable, because there's a lot of folks hawking programs out there that really aren't doing what they say they're teaching you to do. So you really want to see what people are doing. The phone number is right at the top of the screen. It's 970-266-8146. So again, if you'd like to place an order with us, you can totally do it over the phone or just do it through the website at tt4.me/promo. Make sure you put in the promo code. If you call us, make sure you mention the promo code. Say, hey, I just listened to AJ on David's show, and he wants to lock us in.